Hi, and thanks for joining us for Raising Capital with an ICO 2.0. I'm Kinsey Cronin, Director of Business Development at StartEngine, and I'm going to talk about our platform, how the regulations around ICOs work, and how you can use our platform to launch an ICO under a Jobs Act exemption. StartEngine is a funding portal and intermediary which allows companies to raise capital under new regulations designed to allow entrepreneurs to raise. These are the regulations that are going to be the most useful when you want to launch an ICO. But we're going to start with the regulations and then talk about the history of ICOs. So most of the regulations that companies on StartEngine use are from the Jobs Act. That's short for Jumpstart Our Business Startups Act, and it was designed to make it easier for small businesses to get started and to grow. Prior to this act, you had to personally know accredited investors, that is, individuals in the top 4% of wealth, or you had to go to institutions for financing. These laws had been set in place in the 1930s, well before the internet and modern technology. The most important changes that the Jobs Act makes in regards to ICOs is that now there are exemptions in place to allow a company to solicit investors on the internet, and investors don't necessarily have to be accredited. We're going to get into more detail about the different regulations and their parameters in just a few minutes. But here's what's important. Title IV of the Jobs Act, also known as Regulation A+, came into effect in June of 2015, and StartEngine launched the first successful Regulation A+ campaign on that very day. It was a three-wheel car company called Elio Motors. The campaign closed in February of 2016 with $16.9 million in investments, and after that, in May of 2016, another regulation came into effect which made it even easier for smaller businesses to raise capital from the crowd. So by the end of 2017, the OPO industry, that is the online public offering industry, had raised over $1 billion in capital and was growing by 20% per month. As you can imagine, are being used even more now that ICOs have gained popularity and so many blockchain entrepreneurs are looking for legal ways of running an ICO. So what's pretty interesting is that while people in Washington were looking for solutions to help solve some of the US's financial problems, people on the internet were doing the same thing. So in 2009, Bitcoin's created, and similar to the Jobs Act, there was a period of figuring out exactly how this would work before you start seeing your first ICOs. I know there's some controversy over which one was actually first, so we're saying it's Ethereum. Anyway, then you start seeing bigger ICOs, including DAO, which was very successful but then ultimately failed because of a hack, and was also the first ICO to attract the attention of the SEC, which was when StartEngine started getting a lot of calls from people trying to figure out how to use the Jobs Act and stay out of trouble. This past fall, companies started using the Jobs Act exemptions to launch their ICOs, including T0, which used Regulation D in conjunction with Regulation S to raise over $100 million. We're going to talk a little bit more about those particular regulations shortly. So what exactly is an ICO 2.0? Well, basically an ICO 2.0 is the legal version of an ICO 1.0. So taking a look at ICOs as they were, and sometimes unfortunately still are launched, you can basically see no limits, unlimited raise amounts, no regulation, no review of investors, vulnerable to hacks, which of course they still are, but there was only a little legal recourse happening. At least so far, no financial disclosures or accountability were happening in general. And all of that actually adds up to major risks in the legal liability department with regulators and the Justice Department. If you've been paying attention to how the government has been handling these cases, you know that just because some company recently did something and they didn't get sent to jail yet doesn't mean they are not going to go to jail in the future. So ICO 2.0 kind of ends the fun a little bit with limitations on how much can be raised and with requirements of what needs to be disclosed and how the raise needs to be managed, but ultimately it is possible to raise unlimited amounts from non-accredited investors and up to $51 million per year from non-accredited investors, which is pretty great. So let's get into exactly which exemptions are available and what each one means. Okay, here are two of my favorite regulations because they both allow non-accredited investors to participate. So this means that not only can you go out and advertise the opportunity to anyone, but the liquidity is there because the initial investors can also sell their shares to anyone. Of course, In any case where government is allowing for non-wealthy people to invest in private companies, there are stricter rules about what needs to be disclosed and how investors can be communicated with surrounding these two regulations than there would be if you were using other exemptions that only allow you to take funds from accredited investors. Regulation A Plus allows you to raise up to $50 million per year and requires a 2-year audit and an SEC qualification, which generally takes about 3 to 4 months to get and costs around $100,000 in legal and financial services. The great thing about this is that the shares are immediately tradable after they're sold and delivered. But obviously, with those upfront costs, it's not appropriate for all small businesses. So there's another great regulation called regulation crowdfunding, which allows companies to invest, to raise up to 1.07 million per year. And it's far less expensive in both time and money. As you can see, it can be done in as little as a few weeks and costs between $5,000 and $20,000 to launch. And the great thing about both of these exemptions is that you can pair them with other exemptions that allow accredited investors only. So the accredited investors can come in and contribute unlimited amounts without affecting the total allowable under these exemptions. So speaking of those accredited investor only exemptions, here is a little more about them. Reg D 506C allows unlimited amounts to be raised from accredited investors. So there are not specific requirements about what needs to be disclosed, although, of course, what is disclosed cannot be fraudulent. Remember that. You can tailor your private placement memorandum to what you think the investors are most interested in, and the SEC isn't getting involved in what you do or don't need to include in there. The shares do become tradable after a year. I think there is a way to make them tradable a little sooner, but there is a lock on liquidity there that is temporary. But it doesn't take long to set up, and the costs are quite minimal, mostly just marketing and whatever kind of legal or financial advice you want for your PPM. Regulation S is similar, but it's specifically used for international accredited investors. It's not really necessary because we can accept international investors via the Reg D 506C, but some issuers like it because it is specifically designed for international investors, and US investors are actually blocked from seeing it. So I've given you a few options here for regulations, and here's a recommended structure which makes sense for a lot of companies. So you start with a pre-sale under regulation crowdfunding alongside a Reg D and or Reg S, and you do that with a special discount so that investors are motivated to get in and wait the year that they will have to wait for liquidity. Then shortly after that, you do your crowd sale using regulation A+, and the discount will be gone, but there would be immediate liquidity. So this is a great way to get the same investor twice. First time to get in on the deal, and the second time to lock in liquidity early. And if you're looking to raise more than $50 million, you can keep in mind that Reg D and Reg S going through the Reg A+, so you can keep them going through the Reg A+, since the funding there would be unlimited. Okay, so we've talked about the exemptions, and now let's talk a little bit about the structures of the actual offerings. And we're going to put together a little table for you as well so you can understand how they can be combined. The offering structures. These are just 3 examples. I'm going to start in the middle here with tokens that represent shares. So a security token can be sold using cryptocurrency or fiat, and it can be traded on regulated marketplaces. The token may pay dividends depending on what type of equity it represents, and it may be liquidated in an exit, so the owners would get paid out. The purchase is made using a security purchase agreement. Okay, that's one simple way in which a token can represent a security. Those are some of the details there. Now let's look to the right at the SAFT, which is an agreement for we're going to look at the left at the SAFT, which is an agreement for future token, which doesn't exist yet. So in this case, it can also be sold in the same way as a security token or any token for that matter, and it can only be traded on regulated marketplaces. However, what you're selling here is a token that you're going to release in the future, and it is possible that the token you ultimately release would not be a security but would be a utility. Of course, that's going to be subject to careful legal review. One thing to keep in mind here is that in a SAFT, the terms of the token, what it's going to be worth, etc., they must be clearly defined. You can't be vague about what it is that the investor will get in the future. Okay, so let's go over to the right at the rate agreement. RATE stands for Real Agreement for Token and Equity, and it's a sale of two tokens at once. One is the security token, the other is a true utility token. In other words, the utility token is not expected to grow in marketability or become worth more according to market activity, and it's offered as a perk. So a good example of this is if I'm offering you an equity stake in my pizza parlor and I'm also offering you 10 free pizza coupons that you are going to use, that you're going to get to use to eat a pizza. The coupons in this case would be a utility token. If you were buying 1,000 pizza coupons from me, because I promised you that I would create an economy in which the coupons went up in value and you could sell for profit to other customers, that would be considered a security. So that would not be a true utility token. Okay, here are a few examples of securities represented by tokens. One is if the token is worth one share of common B stock, which means it can receive profit dividends and have voting rights. Gab, which is on our platform, is doing something like this. Another example is a preferred stock with a revenue share. This is non-voting and can't be converted to common stock, so the value of equity won't go up, but the token holders will receive a flat percentage of revenue, and this is what T0 is doing on our platform. And finally, the token can represent a debt offering, which means that the holders would receive interest and principal repayment similar to if they bought bonds. And these are just a couple of ways to do it. There's lots of ways. Any way that you might structure a security for any angel investor, you could make, or in most cases, there's a few that aren't appropriate for the crowd, but you get to decide what you want here. So here's a table, the table that I promised you. As you can see, you can use different structures under each regulation. Indico did a SAFT under regulation crowdfunding, and Filecoin did a SAFT under Reg D. So even though they were offering similar instruments, the opportunity was limited to different types of people and could be sold under different circumstances. Then you have GAB, which is doing a direct security token under Reg A+, and T0, which is doing a direct token under Reg D and Reg S. And you can see Reg A+ and Reg CF, they allow for non-accredited investors. Anybody can buy it. Reg D, Reg S are only for accredited investors. You have to be wealthy in order to make these purchases. And we have to verify who you are and how much money you have before you can make the purchase. Once you've decided how you're going to offer your tokens and you've launched, this is how the investments are processed. Investors provide either Ether or Bitcoin, and they are whitelisted to receive the tokens. There's first a test transfer, then a completion of the remaining balance, after which point the investor gets a confirmation of receipt with a signed purchase agreement. That is if the investment comes through cryptocurrency. Of course, you can also allow for investments to come through based on fiat credit cards. Here's how the investors get the tokens. Once the payment comes through, if it's a direct token offering, the investors will get their tokens. Either payments will be automated via the ERC20 smart contract, while Bitcoin and fiat investors will receive an email with instructions for receipt. The great part about doing this with StartEngine is that in the event the tokens are lost, it's very easy to reissue them for investors because ownership is tracked by the transfer agent, including when they're traded, and that brings us to trading. So, how do investors trade regulated tokens? Well, they do have to be traded on registered exchanges, which legally need to be something called an alternative trading system, or ATS. So the way non-security cryptocurrencies are traded right now, there's just a seller, an exchange, and a buyer. With regulation, there's going to be a few more steps. So once a seller puts a token on an ATS and a buyer wants to purchase it, the transaction will go through a registered transfer agent, and the buyer will be reviewed in an anti-money launderer and know your customer check. So that check pretty much makes sure that you don't have anybody buying who might be ineligible to make the purchase. For example, a member of a known terrorist group who might be on a watch list, which would prevent them from purchasing. In the case of tokens that are only available for accredited investors, this step will also include a confirmation of their accreditation status. Once an investor is cleared to purchase, the transaction will go on the Ledger smart contract and will be recorded on the blockchain as well as with the transfer agent. So again, there are two places where the ownership is recorded, which is helpful in the event of a hack. Costs. Okay, costs are very important to understand. We're looking here at the cost for Reg D or Reg S, which are both similar, so they have similar costs. It costs about $250 per investor, regardless of what is invested. So the same cost for someone who invests $100 or $1 million. Usually under these regulations, there's a minimum investment amount, so maybe $5,000, something like that, to avoid having the cost be too high per investor. The premium fee for listing on StartEngine is $25,000, and there's a few other fees associated with this, with the way that the funds are actually transferred, but the main costs are all covered here. Regulation crowdfunding is probably my favorite of these regulations because the costs are so low. This is the only one StartEngine can do a flat fee on, 6% of domestic investments and an additional 2% on any international investments. The premium here is only $5,000, and the other fees are the disbursement fee, which is pretty low, and an added fee for investments that come via credit card. But you can see all the costs with Reg CF are here. There's nothing additional. And then Reg A Plus is really perfect for your very large ICO, but it's also the most expensive of these regulations to comply with. Our fee is only $50 per investor because plus the equivalent in the token, and that's because the average investment per investor is going to be a lot lower than with the other two regulations we mentioned before in the slide before this, since there's going to be non-accredited investors in there. So the average investment amount per investor for these two regulations on this screen are going to be lower than for Reg D and Reg S. The legal and auditing fees for Reg A Plus are pretty high. The premium is the same as Reg D, and the other fees that we mentioned earlier in terms of different types of money processing are going to also apply here. So what does StartEngine handle as part of our service? Pretty much everything other than your direct legal and accounting work. We provide guidance in navigating the regulations, in marketing. We actually have a marketing agency within StartEngine. We connect you to the right players, of course. We have a big summit on April 20th where we can get you a spot to pitch to whales and investors. We create the smart contract. We provide the whitelisting. We've been doing this for a long time, and we've really found the ways to make this process work for entrepreneurs. I mentioned the summit. Here's a little bit more information on that. We would love to have you there, whether you're launching an ICO or you're just interested in learning more. The focus is going to be on liquidity, looking into the future of trading, etc. We have got some incredible speakers and a few awesome pitches lined up. Maybe your ICO can be among them. Again, I'm Kinsey Cronin, Director of Business Development here at StartEngine. Thank you for checking out this video. Reach out to your contact at StartEngine if you have more questions or if you are ready to get started. And don't forget to check back at startengine.com to see what we're launching every day.